Hello and welcome to our session on financial accounting. We define financial accounting as a process of converting the business decisions into financial statements. So we'll take an example to convert the business decisions into these financial statements. So financial statements are the balance sheet, income statement and cash flow statement. We'll see a set of business transactions. Started business with cash on 1st April, 100,000. So this is a receipt. The business is receiving the money. So 100,000 is a receipt, but it's not an income, but a source. So therefore, every receipt is not an income. Raise money by issuing 10% bonds. Once again, there is a receipt which is called bonds, and the amount received is a liability. So this is again an example of a receipt which is not an income but a source. 200,000. Purchase stock of goods for 160,000. We made the payment. So purchase of stock is the acquisition of asset. An acquisition of an asset in this case has resulted in outflow of cash, and acquisition of an asset will be visible on the balance sheet as an asset. So asset will appear 160,000, and to the extent of 160,000 as payment has happened. Now in the next one, we can see that once again we purchase the stock, but we purchase the stock on credit. So there is a creditor of 50,000. The acquisition of stock in this case has happened by creating a liability, whereas in the previous case acquisition of asset has happened through the payment of cash. So we can see that cash of 160,000 payment and a creation of a liability of 50,000 has resulted in a stock of 210,000. Once again, we purchase shares of X company. Acquisition of shares 60,000 for cash, and share will appear as an asset. X shares is an asset. So the assets can be acquired either by creating a liability, or assets can be acquired by making payments. Sold entire stock. We have stock of 210,000 for 700,000. So this is an income. The sales 700,000, and entire sales is for cash. So this is an income and also a cash flow, or a receipt which is also an income. Whereas in the previous two cases, the receipts, but they are not incomes, but a capital and a liability. And whenever there is a sale, because of the matching principle, there has to be cost of goods sold. And here we sold entire stock, so the cost of goods sold is 210. As a result, the stock will become zero, because the stock, which is an asset, has become an expense. Asset is something which has the ability to generate profits or cash flows. Asset is also called unexpired benefit, whereas the expense is an expired benefit. Salary per month is 5,000, and salary paid at the beginning of the next month. So salary, because of accrual principle, will take for the full year, but the salary payment has happened only to the extent of 11 months, because the last months will be paid at the beginning of the next. So March salary will be paid in April, so therefore 1 month's salary will be an outstanding salary. Expense not paid is a liability. Expense, irrespective of the fact whether you paid or not, has to be shown fully for the period because of the accrual principle. So expense is 60,000, payment is 55,000, and a liability, which is an outstanding salary, is a liability. If the expense is more than the payment, there is a liability. And if the expense will be less than the payment, or in other words, if the payment is more than the expense, then there will be an asset. Entire profit has been retained during the period and no other transaction given, but we can see that the bonds have 10% interest. So we have to show interest because of accrual principle. So interest is equal to full year's interest at the rate of 10%, and let us assume that we pay the interest, so interest is 20,000. If we don't pay the interest, then interest will be a liability. For example, in this case, interest is outstanding interest is 0. But since nothing is mentioned, if you don't pay the interest, then outstanding interest will appear on the balance sheet as a liability. So for the time being, let us assume that we paid the interest, so there is no outstanding interest. All transactions done, so the summation of incomes, total income is 700,000, total expense is 290,000, and the profit is 410,000. For the time being, assuming that there is no tax or ignoring tax, we make this profit, and this profit is fully retained in the business. So if it is retained, it is transferred to the balance sheet. The entire profit is transferred to the balance sheet. Then we'll balance the cash flow statement. Cash in hand is equal to total receipts minus total payment. So cash in hand is 705,000, and cash in hand is the asset, so 705. Now we can see that once the profit is transferred to the balance sheet as a retained profit, and cash is transferred to the balance sheet as an asset, and if all other transactions are through, then the balance sheet will automatically tally. So this process of converting these transactions into financial statement is financial accounting, and while doing this process of transferring, converting, measuring these business decisions, we have also been using certain concepts and conventions. Thank you very much.